So welcome back. I've got good news for you. We are a little bit behind schedule, but we'll catch up. This is the last leg of the day. I hope you are not too tired, exhausted, that you're energized by the presentations that we've had. So good afternoon. I'm Arnaud Laviolette. I'm the group CFO. I will go through the presentation about some other activities which we are not able to present today. The first one is D'Ietronimo. Then I will share with you a few slides about our new acquisitions, which is unfortunately not yet closed, which is PHE. And then we'll give you a little bit of how we allocate capital, which is a policy around that. Then Francis will take the relay and speak about the ESG policy at the level of the group and how we cascade that down at the level of the activities. And then I will speak about the ambitions. But that will be a relatively easy exercise for me because it's just adding some numbers and a little bit of subtraction too, but that should be fine. And of course, Francis will be, and I will do the current year trading, and Francis will share some concluding remarks. So, D'Ietronimo, you know we've got nearly six companies, activities in our portfolio. And we are not giving a lot of information about D'Ietronimo, but it is, fully part of the family. It has very long-standing roots, because the place you are here today, we started with an industrial activity here, and we expanded to the place we know today. And this place, by the way, will change dramatically in the next 5 to 7 years, 7 years, because it takes time before you do a renovation or a total renovation in Belgium. So the real estate portfolio, we speak about 37 sites in Belgium exclusively. And they are, by and large, occupied by our activities in Belgium, essentially the automotive activity of Denis and Reginald at around 90%. Okay, so it's an important portfolio because it's more than 800,000 square meters. And just this place here, it's 65,000 square meters in the middle of Brussels in a very attractive neighborhood. And so some potential to be redeveloped. It's mainly in Flanders because of our economic footprint. I think it represents a good representation of the footprint we have of our activities in Belgium. But of course, it is a bit skewed by the importance of the Erps location where we do all the car handling, where the car arrive from Germany or elsewhere, and we redistribute them across Belgium. We have, on an annual basis, around 22 million rental income. We have a few charges, so the EBITDA is around 15 million, and then with a lot of depreciation, we maintain and invest quite significantly in our real estate. So after depreciation, we go down with an EBIT of 7 million. The book value, this is what you see in our accounts, of the total portfolio, is just above 200 million. And we believe that the fair market value is above 300 million. And the strategy there is we are happy with what we have. We try to develop it, to enhance the value of the real estate by investing. We invest sustainably also, nearly 50% of the energy we consume in our buildings, is self-produced, and we intend to go much higher than that in the next few years. And we divest, when we believe that the asset is either non-core or if it is totally mature and that we have an offer that we cannot resist. We could look at opportunities outside of the core automotive activity, but that would be a little bit opportunistically. And we have, it's essentially business occupation, but we have built 3 years ago, and it's fully rented, an apartment, a building with apartment flats, which is fully rented, and so we look at that kind of opportunities too. So this is for real estate. Then the next one is the next growth pillar, the next platform of growth for the group. So you've heard during the whole day the ambition of our management teams. We qualify that, or someone has qualified that as realistic ambition. And we want to continue on that trajectory with the acquisition of Parts Holding Europe. And this is a slide you've already seen, because this is more or less the slide we presented when we did announce the acquisition. The good news is that we have signed now. When we announced, it was not yet signed. And the bad news is not closed yet, because we still need to have the green light of the Commission for antitrust potential issues. Okay, so what is Parts Holding Europe? It's active in a market we know extremely well. You heard Dominic speaking about spare parts. You heard Gary speaking a little bit about spare parts, glass spare parts. You heard about Denis speaking about spare parts. It's a segment of the market we know extremely well, so we feel extraordinarily comfortable there. And we have with PHE a consolidator in the market. It's still a hugely fragmented market. It's a big market in Europe. It's over 80 billion of sales in aggregate, and PHE is only a 2 billion company, growing fast, organically and with some external growth, but it is a very attractive market for us. So it's mainly B2B at 80%, with 6 countries, France having the lion's share of the sales and still growing. So we are number 1 by far in France. Then we are number 2 in Italy. We are consolidating that market. We are number 2 behind LKQ, continue to consolidate that market. We are number 2 in Belgium with some interesting positions. We are number 1 in Catalonia, and we are looking at extending, reinforcing our position in the Iberica, or in the Spanish country, with a few LOI already signed. Number 2 in Italy, I've already mentioned. It's a wide base of customers, so it's very granular. We are not dependent from any customer. It's a very well-distributed customer base. We've got around 70,000 customers, so it's very large. And we deal with kind of affiliated garage, which have normally, the brand of Auto Distribution en France. So we do not own those garages, but they are affiliated to our network, okay? And this creates a lot of stickiness, and this base is increasing. And maybe, I will say some things which will not please Denis, but the growth of what we call the independent players in your sector is going by the year. It's at close to 60%, a little bit above 60% in France, for example, and expected to continue growing, because there is, some price inflation. There is some, so those players are working under the umbrella of the OEMs and the OEM dealerships, which creates quite a nice environment for the smaller players to thrive relatively well. Okay, so that's for the B2B. We've got an important activity in B2C called Oscaro in France. It's fully digital. It's a website which is selling, distributing spare parts for the individuals. And you heard about the SKUs of TVH, so we are not that far with PHE, because we've got 600,000 SKUs for the B2B and close to 1 million SKUs for the online platform that we have. So quite complex, probably not the same long tail as TVH, a little bit more concentrated, but very, very, very deep, And we work with an exceptional logistic platforms. We've got a very granular distribution center whereby we can nearly, distribute every 2 hours or 3 hours or multiple times a day. It's a little bit like the pharmacies. Okay. So revenues, I will come back on that, 2 billion, and I will give you a little bit the performance of 2021, end of the first quarter. So what do we like here on this platform? First, we feel home for the reasons I've mentioned, for historical reasons I've mentioned, but also because we see a lot of drivers which are not easy to capture, of course, but, that will come to us. The first one is, growth, top-line growth of the business. We still see a lot of opportunities in a very fragmented industry to continue to grow market share, because we've got best practice, because in fact we impose to the market, or we try to be in a kind, not subscription model, but imposing a fast delivery, makes it more difficult for competitors. We've got the network, we've got the systems allowing to do that. It has a value for the customer, and so imposing fast delivery is something which helps us, defining the market, assuming our leadership, and increase market share. But on top of that, you still have huge or big acquisition opportunity. And we are very disciplined there. It's, it started with France and then all the adjacent countries, except more the eastern part. But, we've got a strong position, as I've mentioned, in Belgium. We are present in Iberia or in Spain with a local presence in Catalonia, and we expect to expand that very quickly in other Spanish regions. We have created a strong position in Italy, still more to come. And so a lot of potential opportunities, mom and pop shops or small distributors, that we can acquire because there will be challenges for them and because there is some generational changes. And on top of that, you've got big markets which are still untapped by PHE, Germany, Switzerland, the Central Eastern Europe, where there again, a lot of things to be done, service to be improving. And every time we do an acquisition, it's accretive in terms of margin because we have great purchase conditions. So we can immediately compare prices. And that's, the second driver of value in terms of profitability. We continue to increase our size organically. So this allows us to have better purchase conditions. There are some scale effect. And then by doing acquisitions, we always enjoy purchase benefits because we compare the listing price, and we know it's generally more or less the same products. We can compare, and by definition, we'll get higher purchases, better discounts, and better negotiation immediately. On top of that, we invest massively in digitalization, which is helping our processes, which is lowering the cost to serve the customers, and we exchange best practice by implementing them. It takes a little bit more time, as you can imagine, than just negotiating better terms when you buy for the purchased goods. But implementing best practice, looking at the time to serve, looking at the cost to serve the customer, and making sure that we implement the best practice over there. And in terms of cash profile of the activity, it is a relatively high generative unit. We have relatively limited capex. It's around 2.5% of sales, and a model in terms of working capital which is a little bit less consuming than the TVH one because we are around 20% of sales. And the ESG journey is also important there. As for TVH, we are extending life of vehicles. The best thing to do is to do that, to extend the life of those vehicles. We create also affordable mobility for customers because very often, and it is the case in France where the age of the car park is much older than in Belgium, there is an affordability, you mentioned that, affordability of new cars. So extending the life of old cars of the park, is really important. And we see that trend clearly playing now, and especially in the southern countries, France, Italy, Spain. We anticipate electrification to have a lower impact than in Belgium, which is essentially corporate car, where there is a clear corporate policy. But in those countries, it will take much more time. Okay, so we see that also as very attractive. And the ESG journey, we are accelerating there. When I say we are accelerating, we are not yet owners, but it's really clear, very high on our agenda. Okay, and so we believe that the contribution of that activity by 2023 will be closing probably, hopefully, before the end of the third quarter. Okay, so the contribution to 2022 we'll see, in function of the timing, but we are pretty sure to close before the year end. So for 2023, we believe that it will at least contribute to 100 million to the result of the group. So nice accretion. For 2021, robust performance, and even if you look the performance between 2019, 2020, 2021, you've seen the business was relatively resilient. And you remember, what happened in France, the country was more or less blocked, but we were perceived as an essential service, so we've been continuously trading. So the performance in 2021 was solid, you know, with a top-line performance of 14%, 14.1%, but with an organic growth with it, which is double-digit at 11.8%. So robust growth in 2021, and with some confirmed M&A opportunity. We made a few acquisitions in Spain and Italy. You see them, you know, on the middle part of the slide, with 2 acquisitions in Spain, 1 acquisition in Italy, and more to come. And those acquisitions have contributed approximately to 40 million to the top line of the company. And it was not only a top line growth, but also, once again, with the operating leverage, not yet really full benefit of the acquisition. You had an improved profit, you know, with the improved profit margin. And you see here, you know, that EBITDA has been growing by 20.6% at 246 million EBITDA last year. Okay, quite a nice growth, you know, in a catch-up environment, but, you know, more to come, as you will see later on when I will show you the contribution to the first quarter results. So let me now go through, and this is a question we often receive from you, you know, the investment community, about our principles of capital allocation. And you heard it from Francis. You heard it, of course, you know, even because Francis was a kind of promise, you know, but you heard it from our leadership teams, you know, that we have great leaders. And once again, this is key for us. You know, it starts with the people in all our organization, selecting the right people in order to deliver on really ambitious plans. So it starts with having leadership management, developing leaders in their industry. Investing in large and growing markets, and I hope you are convinced, you know, that all the activities, all our businesses have very, very big area to develop themselves, with potential consolidation, as I've just mentioned, with PHE, with proven models. You know, we are not specialists of turnarounds. We invest once again in proven management teams, in proven models. We reinvent. That's part of our mission. You know, we try to reinvent some of the industries, but that goes along with the management teams. You know, we are not imposing our view there. It's making sure that we can really reinvent and scale our business. We often, you know, we are in competition with private equity, or we partner with private equity. And very often a question is, but how do you incentivize management? Okay, that's part of the way we manage our activities, you know, is making sure that there is a clear alignment between the management teams and the shareholders, and that we create the right incentives, as we've done for D'Ieteren. Well, all our activities have a management plan in place, which hopefully will be, you know, making them very successful, not only in their business, but financially. And we are very happy to share part of the value creation on that front. And this leads also, you know, to a very high level of engaged personnel. When we assess the performance, when we scan, this is something very, very crucial for us. It's to feel the energy in the room when we go to a meeting, you know, okay, what's the drive? What's the energy in the room in order to be convinced, okay, there is something unique in this organization. And this leads to, I think, in terms of value creation, very, very clear levers. You know, it's about top line growth. It's about margin, protecting, improving the margin, you know, as much as we can, with a clear attention to capital intensity, but in a smart way, you know, because you heard it from Dominique and Mark, you know, the most stupid thing we could have done entering into the capital of TVH said, okay, your working capital on sales is much too high, it should be 20%, and then you destroy the franchise of the company. Then you destroy the culture. So it's something we are, so relatively low capital intensity, because we are in the B2B to C in the service industry, which is relatively low capital intensive. And of course, with manageable working capital requirements, which is part of also the capital intensity of the model. And then, you know, it's relatively simple after that. We do not try, with D'Ieteren Auto, which has been put in a separate entity, pushed down in separate entity. We ring fence those companies. We ask them to be self-financed, either with their own equity or with borrowed money. So they deal with the banks, they deal with the financial sources, and they are fully independent to do that, of course, with certain guidelines that we are discussing with them. And we put some caps on the leverage. And the leverage you will see here for all activities, it's not a target leverage specifically, it's a kind of limit. And for some of them, it can be a leverage going forward. So let's look at D'Ieteren Auto. We set ourselves a kind of cap to 2 times EBITDA because of the nature of the business. This does not mean that Réginal will have to work with 2 times EBITDA in terms of leverage, okay? He has to have big projects and ambitions, and he has in terms of M&A in order to leverage the company at that point, okay? Because the free cash flow will be more or less equal to the net profit, more or less, and a big part of that will be distributed without really impacting the net financial debt, okay? For Belron, you remember the trajectory we had. Before we did the transaction with CD&R, we releveraged the company to 4.25 times EBITDA before the entry. And for us, that was a hard cap, because we believe that we should not overburden the company with too much debt. Okay, we could have been much higher than that. We could have gone to 6 times, but we believe that it was not the adequate structure for a family-owned company, and making sure that we can resist to any kind of stress test in the organization. Okay, and we have decided now, and this is a conscious choice that we've made together with our joint shareholders, to cap the leverage of Belron by 2025 at 3 times EBITDA, okay? We are currently at 3.22. That was the leverage at the end of last year. The cash flow, the EBITDA will continue to grow. We'll be generating, as you heard, Humphrey, significant free cash flow. And so there is a capacity for us to releverage the business, but we will be converging to 3 times by 2025, okay? For TVH parts, the max leverage, it's not maybe the max leverage, because at some point, if there is a sizable acquisition, we can force ourselves a little bit, making sure that we'll be deleveraging fast after that, but we can go over that if banks or the market help us there. But, having that kind of hard cap at 3.5 times, once again, we are in partnership with another family. It's important that the management team has the right means to develop the company. And you heard the ambition of the management team there. And for Moleskine also, we need first to turn the EBITDA around, to get to a much higher level of EBITDA, and making sure that it is sustainable. And then, we've got a lot of options in order to releverage the business. That part of the financing of Moleskine, it's around 44 million of bank debt. We've got 44 million as we speak of cash, so we can reimburse the banks tomorrow, okay? And we have not levered really, the working capital and so on. So we have other ways to create cash. But we'll refinance that at some point, and we've got a little bit more than 250 million of shareholder loan that we want to refinance, of course, at some point. So we'll be knocking at the doors of the banks in order, when the EBITDA will be at the right level, in order to do a kind of dividend recap, which is a reimbursement of our debt, and that will occur in a few quarters, probably. And with that kind of model, whereby we've got leaders, they reinforce their position, they are growing, they are increasing, hopefully, their margins, and they are relatively, not to spend too much into capital. This generates, platforms of relatively important free cash flows. Okay, you've seen the numbers presented by the management teams, by the objective by 2025, which are quite nice. We are happy about that. But those really will, that shows you that they have all the means, in order to continue on their own trajectory of M&A. They are able to, face some demand from the personnel. They can give back to society, and you heard all of them, have that kind of project. And of course, that we can continue to delight the customers, and that there is something for the management team, as I explained, with the management reward plan. And there is also something for the shareholder, for the D'Ieteren Group, making sure that, we have our share of the value creation. So we've got in place clear dividend policy. You heard it from Reginald for D'Ieteren Auto. You haven't heard it from Dominique and Mark, but we've got a dividend policy in place for TVH. We've got one for Moleskine by, diminishing the shareholder loan, and we've got one with Belron with a clear intention, to distribute large part of the net profit and do dividend recap with the leverage going down, and bring back to the adequate level. And that, once again, free cash flow is recycled for dividends. So we keep some cash at the level of company, so they will be deleveraging too, and we create value with dividends received for us and value creation in the business. So I've mentioned, the journey for the portfolio companies. For us, frankly, we are very, very happy about, the handful, a little bit more than handful now, or tomorrow, of activities, but we want to do more. When we say handful, Francis, tells, we've got two hands. So we intend to continue going forward to redeploy capital in new activities, in new growth platforms. And this is, I think, very, very exciting for us. And so for the shareholders, we continue. We've got a very clear dividend policy, which is, in broad line, it's at least stable and increasing when we can. And we've been able to increase, as shown by Francis in his introduction, quite significantly. But we still have a relatively modest dividend policy. It's around between 25 and 30% of net adjusted profit. And as you've seen, we expect our profit to continue to grow quite significantly in the years to come. So there is room there for improved distributions in the future. We have reinstated our share buyback. You've seen that. It's a relatively modest program, which we intend to end hopefully by the end of the year, or maybe extend a little bit, and we'll see what the future will bring. So more acquisitions, more platforms, better remuneration for the shareholders, and philanthropy. We want to give back to societies, and support good causes. And this is a good transition, I think, for you, Francis, to speak about ESG.
Thank you, Arnaud. I think ESG, everybody has talked about it already today, both in introduction and in all the company's presentations. But we've really upped our game, I think, around ESG across everything that we're doing. And so to become a little bit more concrete, it starts, of course, with the investments that we're doing and our origination work that we're doing. Since we signed the PRI, the Principles of Responsible Investment, it basically allows us to be involved in ESG along the whole value chain of origination. It starts with screening, and we actually included, even in our fishing ponds, if you like, business services is a large fishing pond. Well, ESG is also a business service to some degree, and so we've also identified it as a potential investment theme, who knows. And we've also excluded some sectors that, or either business services or industrials or others, that we would not want to invest in. So we've also limited here and there our fishing ponds around a number of things more linked around armaments and gambling and things like that and so on. Second, most importantly, is that within our due diligences that we do, and of course we have a kind of a four-stage process where we go deeper and deeper and ultimately go to maybe a non-binding offer, maybe a binding offer. But once it gets really serious on a particular file, we do a due diligence just like we do a commercial one and a financial one and a legal one. We also do an ESG due diligence. And it's, of course, an exercise we do as kind of outsiders from the outside in, either on our own or with help from experts. Including, for instance, a materiality analysis that we kind of do from the outside, desktop-based, including risks and opportunities that we're looking at as we can understand the potential acquisition target and look at that. And also have an impact thesis to say, well, what could be improved, what could actually be worked upon so that it's really a positive ESG story if ever we were to do that acquisition. Then around the time of the decision-making, if we get to that point, we actually want to already have an ESG action plan kind of in our pockets. So that on day one, so to say, we have a couple of working hypotheses on what we really think the big levers are for ESG for a particular company. And once we are there and we're signed or closed and so on, well, we're not waiting necessarily for closing. We want to make sure that a number of things already start being discussed with the management. And it can involve putting in place a responsible for ESG, which in some cases exists, in some cases does not yet exist. But it's important, I think, to have that as a dedicated accountability to actually confirm or change the materiality analysis and really make it a joint exercise, including risks and opportunities with management and, of course, the stakeholders, because that's what the materiality analysis does. It's actually interviewing all the stakeholders, managing that comparing it to the management view on the business and the ESG aspects, and then making a kind of a mapping. Translating that into a sustainability strategy for the activity at hand, and then progressing on it and monitoring the progress along the way and reporting on it. Now, the second thing, of course, we do is once we're really in our active ownership of all of our activities, we really have three things we've been working on. One is that we make sure that the ESG value creation drivers at the group level are very clear and very concrete. The second is that within each of the businesses, the sustainability strategy becomes into real pillars, and I think we've heard already a lot about that today. And thirdly, our overall reporting and communication keeps evolving every single year, and I'm sure it will continue to evolve in the years to come. So first of all, at the group level, we have identified 3 KPIs. I think I mentioned that already this morning. One is around people engagement, one around customer satisfaction, and one around CO2 emissions. And as we have started to do that, we have basically started to measure. And I think for 20 and 21, not all the boxes are already filled with numbers, but we have started to progressively start filling the boxes with numbers that are there, that are measured, that we are starting to submit to external assurance, and we've done a limited external assurance already. I think all the boxes where you see little green axis behind it, and I think you heard some of those numbers. You heard about people engagement scores of 88 in Otto in 21, 88 in IMO, by the way, as well, around 86 in Belron and so on. Moleskine uses a different score. But also in customer satisfaction, NPS scores you've heard a lot about. Some of them have already been externally validated, others not yet. And in CO2 emissions, it's a journey, of course, because you started with scope 1, and then we went to scope 2. And in 2022, we will add scope 3. And we want to, of course, reduce the CO2 emissions very clearly and work on that. And so also there, we have started to do some limited external validation already. I think the comparisons between 20 and 21 were quite good. We had declines of minus 17%, minus 25%, minus 34%, minus 11%, and so on. So this is really a journey to go on. But what's very important, I think, that we have now also committed ourselves to the Science-Based Targets Initiative and to say, well, we will ensure we have a science-based target identified, validated by the institute that does that, and that we can work on that, and that each of our activities that we currently have in our group will have this by 2025. So that at least we are on that way, we're on that journey, and there is, quote unquote, no way back, because it is an important thing to work on. Secondly, on the business-specific sustainability pillars, I already talked a little bit about it. We start with the materiality analysis, risks and opportunities, translate it into strategy, into ambitions, into progress. And you've heard, I think, in each of the 4 presentations today, exactly what's been going on that already. And this is becoming very concrete with ambitions and with progress. But it will continue to work on. Yeah? We've identified already last year that through the TCFD, so the Task Force for Climate-Related Financial Disclosures, there are additional requests put upon groups like ours and many corporations, of course, to look at additional items. And so the climate risk and the fact that you are in a particular business, and there are still different definitions on when is a business inclusive or eligible to be part of that and when you're not eligible, and so this will keep evolving. But some of our activities are already eligible, some of them not yet, but when they are, we of course look at the climate risk and we involve in that, and we include that into the business-specific sustainability strategies going forward. And so this is really important that these business-specific, because that's where the action is really. If you think about it, it's in the businesses that it is. I'll give you one example. Dieter and Otto, and I think some of those ambitions were mentioned by Reginald and by Denis. Well, there are very clear sustainability pillars. They are translated into specific KPIs. It's either on GHG emissions, or it's on share of electric vehicles and registrations, or it's on employee engagement scores, or it's on the share of women in CVs, or in recruiting, or in management positions. And we have a value of 2021, and we have a target for 2025, and they are quite ambitious. Yeah? And they are partly linked to hard stuff. I think Reginald mentioned that we have a sustainability-linked loan at D'Ieteren Automotive. Well, there are actually 2 targets specifically linked to be reached by 2025. One is a 50% CO2 emissions reduction, and the second is a 28% of fully electric vehicle in the sales of new cars in the year 2025. And this is relatively in line with the ambitions that we've seen, might even go a little bit faster, hopefully, on the sales of the battery electric vehicles. But so it shows you that I think it's not just a bit about what we are today, it's also about ambitions of 2025. They are concrete, and they can be linked to very hard things like loans. Yeah? And I think it's a very good thing. And we have this, by the way, increasingly at all of our activities. And then last but not least, this all leads as well to more and more ESG-related reporting and communication. And I think this is quite important because you may have sensed this today, but I think we have started to do that systematically, not only in our annual reports, but mainly through that we give detailed disclosure on each of our businesses. I don't not necessarily think everybody does that, but we think it's important to be as transparent as possible about it, because that's the name of the game around ESG. And to, of course, try and quantify it more and more as we can. Some things are still qualitative, but we want to be quantified KPIs more and more. We will include the TCFD I already mentioned. The EU taxonomy keeps evolving as well. And every year there's new things. And so we keep monitoring. We keep saying what is valuable, what is value add, and then we will include when we think it is so. And then we put, of course, external assurance on that. And also there we started limited, and we will expand that over time as well. And as we see this in the annual report, which is coming out, I think has been coming out as we speak online, it will be, it is available. You see that we report about this quite extensively and for all to look at. So this is, I think, ESG in a nutshell. I'm sure we could talk a lot more about it, but I think we take it very seriously, and it is all over the place within the D'Ieteren Group, both at the group and at the activities. And with that, I give back to Arnaud to give us a bit of an outlook on what are our ambitions for 2025, Arnaud?
Thank you, Francis. So indeed, a few numbers, sorry for that, but I hope that it will be energizing, inspiring for you, as they are for me, at least. So you heard it from the activities. The level of ambition is there, no doubt about that. The commitment to deliver, you've heard them all, they're on them. They're focusing on execution, which is really what really matters now. So what does it give? We wanted to summarize and then add up all those ambitions in order for you to have a clear picture of where we want to land by 2025. So you've got here a summary of our activities, starting with D'Ieteren Auto. You heard it, sales growth of 10%. Who in this room was entering the room by believing that that activity would be growing by 10%? And you heard why we believe it's really well substantiated. We are down the valley, and we see with the order book, with the quality of the order book, with the mix of the order book, that it is highly achievable. On top of that, we've got the growth of the new services because we want to provide a better sustainable mobility for our customers. And then the margin, we are not we do not believe that the margins will be diminishing. On the contrary, we are managing for value more and more. We are looking at cost opportunities. We are looking at pricing opportunities. The new activities should be enhancing that margin in the future. So we strongly believe that will be over the 4% EBIT margin by 2025. And in terms of free cash flow, it's really an ambitious target, that one, because you remember what we've generated the last 2 years, a little bit helped by, and that's sometimes the beauty of activities when business is, the environment is a little bit tougher. We generate massive free cash flow the last 2 years. I think it's close to 270 million of free cash flow generated by that activity alone, and we expect it to continue because of the improved profitability, because of the discipline on CapEx and on working capital. And then on Belron, you heard it, the ambition is there too. And it's a continuation of what they've been doing the last years, and about top line, you heard it. We do that for the last 30 years. So it's a continuation of what we've been doing. And the opportunities are there, the opportunities to gain market share, the investment we do in digital, the more complex job that we are performing create a higher barrier of entry for our competitors. So we believe that we'll continuously be able to translate that into higher AGP, the average job price. We continue to gain market share. ADAS is a clear tailwind. You know, you've seen the demonstration there. It's the penetration rate of 24%. We know mathematically, arithmetically, it will continue to grow, you know. And the same for VAPS, because we know that by benchmarking the countries, it's an organization, you know, when you tell them there is an opportunity there, they grab it and they go for it. Okay, so high single digit in terms of sales, the margin more than 25%, 23%, sorry, by 2025. You've seen the trajectory. We were quite low, frankly, you know, in 2016, 2017. And the trajectory has been extraordinary, and we continue to believe that there is more to come. Because of the value mix, because of the way we will improve the productivity of our technician, because the way we'll improve all the operations, the back office, you know, with the transformation plan, because of top line, and because of ADAS and VAPS, which have a relatively good contribution, as you can imagine. Okay? In terms of free cash flow, it's also there. Even if we are investing quite heavily in new tooling, you heard it, in order to reinforce our competitive position, we'll be hopefully generating more than 850 million a year, and that's the net cash flow. It's with the current interest rates we know, with the current tax rate we know, but it's quite significant. And this includes, by the way, some M&A spend, you know, in that number. For TVH parts, you heard it, you know, 8%. 8% before inflation, okay? So it's a kind of, not only volume, because there is some value there. There is some value and there is some volume. But we are not in that number capturing the opportunities that an inflationary environment brings to us, you know, and our capacity to translate that into higher prices. So 8% a year, and you know, this is what the company has been achieving for the last 20 years. Okay, so once again, no revolution, no big change, you know, it's just continuing to execute in a market full of opportunities. Operating margin above 14%, which is, you know, for a distribution company, it's quite extraordinary. You heard, Dominique, you know, about the impact that the mix of segments could have, you know. We'll see, it's probably, you know, it has to be managed. We hope that by gaining market share there, we'll be able to improve potentially, but still quite a comfortable EBIT margin. And the free cash flow, you know, targeting 170 million by 2025 and investing heavily in our footprint. You heard it, you've seen it. You know, we've got more than 300,000 square meters of warehouse. We continue to build on that because it's a critical, you know, advantage for us to be able to have the right footprint closer to the end customers with the adequate technology in the warehouses. So substantial investments there. And once again, that will reinforce the position of the company going forward. And Måneskin, you heard it, you know, low double-digit top line growth, you know, it's probably just above the one of D'Ieteren Auto, with an adjusted EBIT margin above 25%, you know, going back to the historical level. And you heard the relentless focus of Daniela about gross margin, you know, growing top line in the adequate products, you know, in the adequate categories, in the adequate segments of the market, you know. And so we believe that we'll go there and hopefully higher, and with an adjusted free cash flow by 2025 above 30 million. And that will also help, you know, in deleveraging the company, not only for the bank debt, you know, but reimbursing cash to D'Ieteren loan. The next exercise is relatively simple. You know, as I mentioned in my introduction, it's just adding numbers to give you a flavor of where we would be landing in terms of EBIT if everything comes to fruition by 2025. So you see where the trajectory has been fine till 2021, and we continue on that trajectory, and we believe that our activities combined, that the group share, you know, will be over the mark of 1 billion EBIT for the group share. okay? And this is without the contribution of PHE, which, you know, you've seen what we expect for 2023. By 2025, it hopefully will be much higher than that. So quite an ambition plan, realistically ambitious, you know, and we like to have that kind of challenges in front of us and hopefully to deliver and even do better than that. So, you know our KPI, the profit before tax group share. There we just miss the mark. You know, we've been maybe a little bit too conservative there, but we just missed the mark of the 1 billion by reaching hopefully more than 950 million. Sorry. Yes, thank you, Francis. By 2025, there is also our guidance for 2022, and I will come back on that. So this is a consequence, of course, of what you've seen before. You know, the EBIT, we've got relatively low financial charges, and so the adjusted PBT just below 1 billion. And what about free cash flow? You heard it. You know, we tried, you know, in this presentation to be relatively systematic on some financial KPIs, you know, and free cash flow is an essential dimension for us in terms of value creation. And so if we add up all the free cash flow of our activities, you know, and this is the equity free cash flow. It's after, you know, paying taxes, interest, working cap, capex, some M&A for Belron, you know, we expect to be close to 2 billion, you know, in cumulated free cash flow for the period, which is quite significant and which will allow the companies to have potentially, you know, some strategic M&A to be able to deliver on that one. But it will also allow the group to capture part of that free cash flow. When I say the group, it's D'Ieteren Group, by increased dividends from the activity, dividend recaps, as I mentioned, for some of them. And so rapid deleveraging at the level of the companies and a dividend policy which is very clear, which will be upstreaming the cash at the level of the group, which is, you know, always welcome for you as shareholders, for us as management, and making sure that we continue on our journey around, you know, building a portfolio of companies. Now I move to current trading. You heard it also from the activities. We are quite pleased, even if the environment, you know, in terms of inflationary pressures, and there have been a lot of questions around that, and I fully understand. And once again, I hope that you have perceived that all our activities, because of their leadership positions, because of the strength of the brands, because of the discipline and the skills of the management teams, we are kind of, you know, paranoid about that. You know, it's a topic we discuss with all the management team, making sure that exploiting is not the right word, you know, but we are not complacent with inflation, and we can reflect inflationary pressure in our prices because we deliver an extraordinary services. Okay, that's very, very clear. You know, that we should not be shy about that because it's the right thing to do, because we face inflationary pressures. And some of those inflationary pressures, we do not even see them today. There will be some lagging effect, you know. Salaries, you know, are not adjusted immediately. So we'll see that maybe more in the second half of the year. Some material costs, you know, we see them relatively quickly. Transport, we saw that already, you know, in 2021. But once again, the message there is to the management teams, and they do not need us to do it. You know, it's not to be complacent, making sure that we, you know, capitalize on our strengths, you know, and that we increase our prices. Okay. So strong brands, distribution models also, you know, you heard it. It's essentially distribution models. And when you've got inventory and the management, and unfortunately, you know, D'Ieteren Auto could not move up its inventory because we were not receiving the cars. But for the other activities, I think we played it relatively smart. You know, you heard Daniela speaking about the never out of stock. So we built quite considerable inventory in order to be sure that we can deliver. You heard Dominique and Mark about anticipating, you know, because we knew that after a crisis it comes back, you know, and investing in inventory way in advance, and we reap the benefit of that today. Same more or less for Belron, which is even, you know, it's a little bit under tension always, but also anticipating relatively well on the inventory needs. So I will not be repeating what you heard from the activities, but this is an obsessionary, discussion we have, making sure that we can reflect the inflationary pressures on our sales price and potentially benefiting from it. So trading level of our activities, you heard it, so I'll be summarizing there again. Once again, the D'Ieteren Auto has had an extraordinary performance. I think that we should recognize that, in such a tough environment, where the cars are simply not there. The customers are queuing, and you've seen the order book, but we cannot deliver. And by the way, I've got a lot of sympathy for the teams there, the commercial teams, which probably have on the phone their customers waiting for their cars and not getting them. So frankly, the performance during the first quarter has been extraordinary in those very, very tough circumstances. So volume down and sales up 7%. Volume down close to 15%. Okay, positive mix impact, so we are pleased with that. As you can imagine, sales diversification starts to bear benefits and fruits, and the order book, is just incredible with very, very low cancellations, as mentioned by Denis. Belron, again, what a quarter. And not in very easy circumstances, especially for Europe, because the weather, we do not blame the weather anymore, that, but it has been a relatively mild weather, while it was better for us in the US. But again, what a strong performance. And you remember when we presented the guidance for the year, we said that it would be more volume driven than anything else. And you see here the contribution of high volumes, close to 10%, but also, of course, the tailwinds, the famous tailwinds of ADAS and VAPs continuing to contribute, and some price, of course, some price increase, and a little bit relatively strong dollar, helping the performance with plus 4%. TVH parts, wow, what a quarter, plus 23%. And of course, there were positive tailwind from acquisition and from FX. But even before that, after that, look at the performance. It's mainly volume and some price actions, tactical price actions, which have been taken here. It's we believe that we are gaining market share. We've got the inventory, so it's a great opportunity to capitalize on that and really reinforce our positions in the market. And quite impressive performance by the team there. And once again, just imagine, get out of COVID, you've got people coming back at work, and generating those levels of performance, of growth, is really, highly demanding for the organization. But we keep very high engagement scores, so I think full credit for the team. Same for Moleskine, back to growth, plus 29% with some positive tailwind from FX. Once again, US are back on track. We see some traction there. Same for Europe, recovering progressively. The retail segment progressively also recovering, not yet totally where we were in 2019, but it bodes well, for the rest of the year with a positive FX impact of plus 5%. And then PHE, I mentioned the performance of 2021, but look at the start of the year. In a sector, you probably would not imagine that, this is the kind of growth we could see. But once again, strict discipline on price, market share gains, good volumes, and a little bit of help of acquisition. So organically, plus 9.4%, and M&A growth, plus 5.1%. So very, very solid numbers indeed for the first quarter. So I know that this may be for you the disappointing part of the presentation here, by, confirming the guidance. But once again, we are not in, that, we are not publishing any quarterly results. We will be potentially guiding maybe guiding a new, or having a new guidance when we'll be publishing the first half results. Indeed, the business has been performing well, very well during the first quarter. We are happy about that. But the world is incredibly uncertain and volatile outside. So we want to remain relatively cautious, want to have the first half of the year under, in the bag, before reassessing potentially, the outlook. And I remember, well, I will not read that, but the outlook we've given when we provide the guidance, when we announce our yearly results. So we stick to the guidance as from now. It's a growth of minimum 25% of our adjusted growth, adjusted PBT group share, and this is of course before PHE. So Francis.
We have time for questions if you want.
Oh, of course. Any questions?
Thank you. So yes, you've said indeed that the activities will generate very significant free cash flow, and quite a bit of that will be upstreamed to D'Ieteren. So you've mentioned something which I found interesting, that there will be room for strategic M&A. Do we have to understand that you could basically reinvest, for instance, in TVH, in case you would have like a beautiful and significant acquisition there?
Well, you heard it from the manager. If there are nice transformative M&A, and it's the case for TVH, it's the case for Moneskin, it's the case for D'Ieteren Auto, it's the case for Bellon, for a lot of activities, we would not be shying away from strategic M&A, making sure that they are value creative, because, sometimes strategic M&A is a word for value destruction. But yes, we'll seize opportunities if they are relevant and value creative.
And over the next, let's say, 4 years, what is, in your view, the likelihood that you actually invest in a handful of new activities? So I understand 1, 2, 3, 4, or rather reinvest in the business.
You need to tango, and we need to be sure. Well, there will be opportunities. Okay, the question is the valuation good for us? And that's a challenge, even in the current environment, So the valuation, the public markets have been declining a little bit, but not on the private side. M&A remain relatively intense. Private equity has a lot of firing power. They are looking at all the opportunities, and so it's still a very, very competitive world there. So, we would welcome a crisis there, a kind of crisis on debt, because all our activities are very well financed, which will probably, hopefully, mitigate the appetite and the firing powers of those private equity houses. But so, we once again, you heard the criteria from Francis, okay? And we have a very disciplined approach in terms of screening, and we see a lot of opportunities. But it has to meet some criteria about management teams. The intention of management teams to work with us. That, for us, it's one of the most important criteria. That is a desire to enter into a company, a family-owned company, listed family-owned company like D'Ieteren, because this is a different trajectory than being owned by private equity. Okay, so we need really two to tango in making sure that the valuation is compelling, that we can create value. And I guess that you heard the growth prospect of TVH. The multiple was relatively rich, but you hear the growth prospect. We'll have forgotten about that multiple very, very soon. And then for PHE, you remember the multiples. It's 7 times EBITDA. It seems to be very compelling for a management team where we believe that we have a lot of things to do together for the coming years.
Exactly, that's my last question. On PHE, indeed, this is, if I'm correct, the first time that you buy actually a company which was owned by private equity. Can you tell us more about the incentive structure that you have in mind for this management team? What kind of dilution should we have in mind? Thinking about Belron here, of course.
So I will not enter into too much detail about the capital structure. So the good news is that the management team is reinvesting more than we expected, in the equity of this transaction. So the equity of this transaction is around 540 million, okay? Maybe more, maybe a little bit less, in function of some reinvestments. So the management is reinvesting a higher percentage of what they have, they will receive, when we'll do the sale. So that's the first point. And then, we create kind of curves with them in order to say, and we create kind of synthetic exit, because we'll not be exiting that activity. You know, we are not sellers of assets. So we create kind of synthetic exit with applying the multiple of entry to the EBITDA minus financial debt. We look at the value creation in terms of equity in 5 years with the management, and in function of the multiple of our equity, you know, we'll share a more than proportionate share of the value creation with them. So I will not give you the detail of the curve, you know, but it's quite a nice one, you know, if they're able to double, triple the value of the company.
Yeah, a question from the online audience. Do you already have a long-term leverage target in mind for PHE? And will this be in line with your existing portfolio companies?
It's a very good question. It's a relatively highly leveraged company as we speak. So for us, it's a kind of cap. And we're expecting their free cash flow and their growth, you know, to be able to mitigate, to diminish that. On top of that, we are trying to put in place a financing where we could temporarily go above the current metrics. So, you know, we would like in 5 years, for example, if I projecting myself in 5 years, you know, to have a lower leverage, you know, and probably go at around 3 times, 2.5 times for that company.
All right. One more question.
Mark-Elier Kempen, on PHE. Maybe I heard it wrong, but I think during the presentation of Dieter and Otto, I think it was mentioned that if you move towards electrical cars, that the impact on the spare part business could be 30%. I know that this is really a long-term trajectory, so it would only impact PHE probably in, more or less 10 years. Still, I would be happy to hear how you believe you can manage that.
Okay, first we strongly believe in electrification of the car park, and especially new car sales, you know, will be, you heard the targets of Denis about that. You know. So we believe that electrification will be impactful. So, but the countries we're in France, in Italy, and in Spain, which are the 3 largest countries, you know, we believe that trend will be there, but not as aggressive as in Belgium. And in our analysis, you know, by 2030, I think we believe that this could have an impact, you know, that the electric cars in the car park, because the car park in France is much older than the car park in Belgium, that it could have an impact of 6% of the car park being electric in France. And so the impact will be much more modest at that time. And on top of that, you know, electrification increased dramatically complexity, increase also dramatically the competences you need to have in order to work on those cars. So this will bring us other opportunities, will broaden the scope, the range of products. And once again, due to our size, you know, we'll be, you know, one of the only being able to provide service and parts for that activity. On top of that, you know, in the current mix of activity of PHE, the internal combustion engine represent only 25% of their sales. So the parts to be replaced for the engine represent only 25% of the sales. So it's relatively modest, you know, at the end of the day, the impact by 2030. After that, it can increase, you know, because the penetration rate will continue, but we'll be managing that.
Thank you. And then another one that I have is on TVH. Could you disclose the dividend policy?
You know, we've agreed on a payout, which is just north of 50%.
And then
Patrick, you allow me to say that? I've got the chairman here.
And then a final question I have. Not sure if it's too important, but I think I was a bit surprised to hear that at Belron, this is the only asset where in the free cash flow guidance it includes some M&A.
Yes.
Is that because it's not too much, or because if I look back historically, I think M&A could be around 70 million per annum. Of course, there were some big transactions in that, so if you exclude it, it's
the average, you know,
rather,
because you had True Road on that numbers, you know, which was the largest acquisitions we've ever done. In fact, that is a little bit skewing the numbers. But no, I think it's a realistic number. But M&A, you never know. So we've taken a kind of average, what we believe will be delivering and doing there. But it's a guess, which is educated, but, with some volatility in that number.
So that's rather 40, 50 million included
Yes.
for M&A. Yeah, thank you.
All right. Let's try and wrap up. Yeah. One more question? Sure. Sorry. 2 questions then. Okay. 2 last questions.
Yes, hi. Thanks for taking the question. I was wondering if I can come back on PHE, because one of the striking elements to me when I'm listening to the presentations is there is one common factor between the different businesses. One of them being logistic, flows management, and competences on logistic. When I'm hearing you on PHE, I think that you mentioned that you do not expect much synergies between PHEs, TVH, and the others. Is it because it's not closed yet, and therefore should we expect any updates on the synergies that you can extract from the different businesses on this element, or how do you see the synergies between the different businesses?
I mean, if I may start, maybe you can follow up. As you know, we don't look for hard synergies between our activities. Each family member has its own identity and has its own strategy, its own approach. But nevertheless, you can do lots of best practice exchanges. And so if you talk about that topic, it is clear that given our portfolio today and tomorrow even more, there's lots of stuff to learn from each other. But fully realizing that even if it's the word logistics, what the logistics is supposed to do in PHE is not the same as what it's supposed to do in TVH, or what it's supposed to do in D'Ieteren Automotive, or in Moleskine, or in Belron for that matter. So it's not the same. It has the same word, logistics, but what's behind that may be very different realities. And so, but there's lots of learnings, per definition, lots of learnings. And so that goes without saying that we will exchange either bilaterally or multilaterally on topics that are pertinent. But as you know, we don't look for hard synergies between the activities because that's not the nature of the group that we're building. Yeah.
Perfect.
It's good, eh? Yeah.
Oh.
I would hire him. Yeah. No, I have, if I may, 3 very short questions. 2 are very smart, and 1 is stupid and will never get an answer. But the first 2 are on PHE. Can you help me reconciling the 21 EBITDA with the pre-tax profit? I mean, because it's your 23 pre-tax profit expected is far below what I would imagine being the 21 pre-tax. So what is 100? Is 150 that you expect, but you say 100 so you don't disappoint the market? Or the second question, I'll give you all the questions.
That was a smart question, or?
No, this is a smart question. And the second question is on Belron and the recalibrations. I mean, you've always been talking about 2% increase in the percentage of recap.
No, 4%. 4% a year.
4%.
So 4%.
1% per quarter, 4% per year.
Yeah, 4%.
But the contribution to sales, you've seen it, is 2% incremental growth.
Yeah, but eventually, during today's presentation and stuff, you made us understanding that this could actually be a bit better than that. So the acceleration can be even greater. But on your forecast, you remain more or less, actually a bit less than this 4% increase. So is there any sense in that, or I've been reading?
No, I mean, you see the curves. Management showed some curves per some of the key countries, not all countries, but some of the top countries, and it's
Yeah, but that is the curve. No, that is the curve of cars having
penetration of
ADAS
within
within
replacements.
cars. Yeah.
Within cars, yes, exactly. So you have to still translate a bit. Yeah.
Okay, within cars. But then there's a market share that, due to legislation, due to that you naturally gain,
Yes.
which is not included,
Yeah.
maybe.
That's right.
Okay. And the third, so sorry, PHE.
So PHE, I'll try. Maybe I will need the help of my team here. But they published 246 million of EBITDA. You've got a relatively high right of use. Then you've got the real depreciation. So you can deduct a little bit more than 90 million out of that to get to the EBIT level. Okay, so this brings us, let's say, to 150 million. Then you've got 60 million, a little bit more than 60 million of financial charge because they pay relatively high interest rates. So you get to 90, a little bit more, less than 90 million.
So maybe I was missing the right of use. And
Exactly.
Okay. And the last question, the most stupid, where there will be no answer. What the potential way out for Belron private equities? I mean, have you... because as
It's a good
we are
question.
shareholders of the holding company, and we recognize that that asset, which is currently representing 70% plus of the overall value in our eyes, is underrepresented by the current share price of D'Ieteren shares. So one way of unlocking that value would be just to ask the market to value it, yeah? So you can do it one way, two ways. They sell it to the market as an IPO, you do the IPO and you give us the Belron shares like Ferrari with the Fiat did in the past, yeah? And
Like Porsche with Volkswagen.
Yeah, that's fine, yeah. Well, you know, I'm Italian, so it's...
No, it's it's not a stupid question at all. I think we are very happy about the shareholders who are sitting around the table next to us. We were very happy about CD&R. We are very happy to have. Can you imagine? We've got the best of breed. I think with Hellman and Friedman, BlackRock, and GIC. So it's a very fantastic club of shareholders. And we know for sure that they will be exiting at some point. But what we've created with this transaction, it's creating more optionality. We give a little more time to CD&R. We institutionalize the shareholder base of the company. And that could be a trajectory for the future. We don't know. So it could be an IPO. It could be another round with private equity, with financial institutions, or with institutions, entering into the shareholdership of Belron. And by the way, it allows us to come back on this transaction. Once again, this is a demonstration that Belron is one of the best service company in the world. And I know that some of you knew that, had anticipated that. But you've seen the multiple, it's a quite nice multiple. It's not stretched, We've got probably the most astute investors in the world having paid for that. Okay, so I was a little bit upset by the comment we received, when we published our annual results, kind of discussing about the performance of the second half. They are not looking at that, they are looking way further. And we are happy to have them on board.
Thank you.
Yeah, we're really going to have to stop the questioning. This is a very short one.
Just a quick follow-up on the PHE.
Yeah. Okay.
Sorry, so you said 90 million PBT for PHE. I think you said CapEx was about 2.5% of sales, is that right? So
Yeah,
cash
that's without right of use.
okay, which is a cash line.
Yes.
Okay. So is there much difference between the cash flow and the PBT, I guess?
Yes.
But
The big difference between which cash flow and the PBT?
well, free cash flow and net income, is there much?
Yes, that's the best proxy you can have.
They're about similar?
Yes.
Okay, thanks.
All right. All right. Has been a very intense day. I'll keep it quite short. I had 3 key messages looking backwards. I have 3 key messages looking forward. What I would like you to take away from today, it's another ESG. It's the E from execute, the S from share, and the G from grow. We've seen ambitious medium-term targets, and so we'll have a lot of focus on execution in each of our activities, with, of course, the strong management teams, but also with the best practice sharing, which I think you can really now start doing a lot more between the activities. And so execute is absolutely key. Share, there's lots, I think, if you look at those plans, to share in the years to come, with management teams, with the personnel, towards society, but also with you shareholders. And I think you've heard about the dividend policy for us as a group and the way that we will be able to create some momentum around that going forward. And grow is that we want to continue to grow, yeah? And of course, first of all, help each of our activities to grow and to have the means to grow, but also to continue on our own journey, We don't have two hands, actually. We have one big hand. And so, well, in a family, you add one family member at a time, and we'll keep doing our origination along that matter. So I can say our mission is very clear. Our focus on excellence is very sharp. Our hunger for meaningful impact is absolutely intact. There will be lots of uncertainty going forward, I'm sure, but we're very excited for the years ahead and look forward already to the next Investor Day in a couple of years from now. So thank